Hello everyone, my name is Alayya and I'm from the International Finance course. I will try to summarize the lessons that we've learned from the first week to the 7th week in the form of mind map. So let's get started. Okay, so here's the overview of the mind map. Okay, during the first weeks of the course, we reviewed the lessons from the corporate finance. So 4 cornerstones of corporate finance. First is core value, which is the combination of growth and return on invested capital, drives value and value creation. Second cornerstone, the conservation value. Value is created for shareholders when companies generate higher cash flows, not by rearranging investors' claim on those cash flows. Third cornerstone is the expectation treadmill, which is the company's performance in the stock market is driven by changes in the stock market's expectations, not just the company's actual performance. Fourth cornerstone, the best owner, the value of a business depends on who is managing it and what strategy that they pursue. Talking about value creation, so the present value of benefits must exceed the investment or cost. In other words, what we receive is more than what we get. Another important lesson that we learn is principal agent problem. So there's shareholder manager conflict. So shareholders hire managers to operate the firm. However, managers might not act in ways that maximize the shareholders' wealth. Theory of the firm involved here are managerial behavior, agency costs, and ownership structure. So basically, the principal is the shareholder, agent is the manager, and between them, the conflict of interest might rise. So the principal delegates authority to the manager and the agent. The agent later on, the agent will do the decision making, and at the end, the principal will evaluate whether the managers are maximizing the shareholders' wealth and making the company better or not. So we have issues on asymmetric information like adverse selection, market process in which buyers or sellers of a product or service are able to use their private knowledge of the risk factors involved in the transaction to maximize their outcomes at the expense of the other parties to the transaction. For moral hazard, it is when an individual takes more risk because he knows that he is protected due to another individual bearing the cost of their risk. Example of the adverse selection is like the second-hand car markets, hiring in labor markets, markets for healthcare. Examples for moral hazards like management employment contracts, wage contracts, and markets for healthcare. So how do we solve the problems? So here are the ways to solve the problem. We can write down a contract to motivate the agent to act in the interest of the principal, and by adding the KPI to make it clearer to the agent, and then to establish protocols for agent surveillance, and then GCG, training, better recruitment process, providing agent compensation in the form of stock options or deferred salary. And moving on to the international opportunities, we discuss about the multinational corporations or company. So for investment opportunity, the marginal returns on MNC projects are above those of purely domestic firms since MNCs have expanded opportunity sets of possible projects from which to select. For example, this MNC can choose the projects in Thailand, Malaysia, or Singapore instead of their home country. For example, if they want to do projects in Southeast Asia region. And then for financial opportunities, MNCs can obtain capital funding at a lower cost due to their larger opportunity set of funding sources around the world. So those are the advantages gained by MNCs compared to the purely domestic firms. For cost-benefit evaluation for purely domestic firms versus MNCs, so marginal return on domestic projects is lower and the marginal cost of capital is higher. Therefore, the profit generated is lower compared to MNC. However, for MNC, the return is higher and the cost is lower. Therefore, the profit generated is higher compared to the purely domestic firms. Next, for international risk exposure, there are exchange rate movements and then foreign economies, and then political risk. And another important lesson that we learn is about arbitrage. So two prices do not conform with the parity framework. So basically, you make money with small risk and the price is not harmonious. There's discrepancy. We're creating a position to realize a riskless, sure profit from market disequilibrium. What are the types of the arbitrage? First, locational. You can buy low and sell high almost at the same time. Then triangular, you buy at lower price, sell at higher price, and this usually occurs during crisis, not every time. And then covered interest arbitrage capitalizes on discrepancies between the forward rate and the interest rate differential. Okay, so we studied about arbitrage. Moving on to the next. So we learn about the absolute form of purchasing power parity. So I'm trying to give the example from the Big Mac case. For example, in United States, the Big Mac price is $5 per Big Mac, and Indonesia is $2 per Big Mac. For example, $1 equals to 15,000 rupiah. So it's 30,000 rupiah here in Indonesia, the price of one Big Mac. And the purchasing power parity, we can divide it, $5 divided by $2, we got 2.5. And basically, the factors influencing those prices are the minimum wage for employees, because in US it's higher than Indonesia, and then the cost of living also it is higher in the US compared to Indonesia. And the definition of the absolute form of purchasing power parity itself is an extension of the law of one price. It suggests that the prices of the same products in different countries should be equal when measured in common currency. So, relative form of purchasing power parity. So it accounts for market imperfections like transportation costs, tariffs and quotas, minimum wage, cost of living, etc. So this is like what I've explained from the previous example. I mentioned about minimum wage and cost of living difference between two countries. So it states that the rate of price changes should be similar. We also learn about forecasting exchange rate. So we learn about exchange rate, and we also learn how to forecast it through mini project. And we learned that there are several methods to forecast exchange rate. At first, technical, it involves the use of historical data to predict future values. And then fundamental, it is based on the fundamental relationships between the economic variables and exchange rates. And then for market-based, we're developing forecasts from market indicators. And then mix, it is a combination of the three forecasting techniques that I've mentioned before. Okay, we learn about the efficient market theory. So it is developed by Eugene Fama. So this is a hypothesis that states that share prices reflect all available information, and consistently trying to beat the market is impossible. So instead of trying to beat the market, why don't we mimic the market? So that's why the exchange traded funds or the index funds are created. So is the market efficient? So according to Eugene Fama, it is efficient. According to Fisher Black, who is trying to be politically correct, yes, but the market price must be within the -2 standard deviation to the +2 standard deviation. So there's a range for it. According to Grossman-Stiglitz, it is impossible for the market to be 100% efficient. Moving on to the next. For currency risk exposure, we have transaction exposure. So the risk that transaction exposure is the risk that current exchange risk will fluctuate after a firm has already undertaken a financial obligation. It reflects the exposure of an MNC's future cash transactions to exchange rate movements. For economic exposure relates to the long-term risk of operation across different currencies and economic systems. Last but not least is the translation exposure. It is a risk on the shifting valuation of assets onto balance sheets, where the balance sheet is operating across multiple different currencies, or how changes in the exchange rates affect the translated value of foreign assets and liabilities. We also learn about the downstream industry policy. So basically, the downstream industry policy refers to strategies implemented by governments to promote the processing of raw materials within the country where they are mined. This is often done to increase the added value of these materials and to boost the country's revenue. It is important to note that downstream industry policies can have environmental and social impacts as well, such as deforestation, water pollution, environmental emissions, and labor right abuses. Therefore, a balanced and sustainable approach is crucial when implementing such policies. So, the next discussion is, why is it important? So first, it can boost economic growth. So Indonesia's export associated with nickel climbed from 6 billion US dollars in 2013 to around 30 billion US dollars in 2022. And then for job creation from 2019 to 2023, the downstream industrial sector experienced an average annual growth in the job creation for 26.9%, and then supporting small and medium-sized industries because the government is trying to maintain the productivity of the SMEs through this policy, and then also give rise to tourism business because of the good economic growth and increasing job opportunities. People are now more interested to travel, so it can boost the tourism business domestically. And then it can even open electricity access to areas directly impacted by the downstream industry, and then can positively affect the tax and non-tax state income like the corporate income tax, pajak penghasilan, value-added tax, pajak pertambahan nilai, and royalty 1.5% from the yield of the product, and etc. So the policy was created since the SB's governmental era through Law Number 4 2009 on mineral and coal mining. And then this law was refined with Law Number 3 of 2020 during Jokowi's governmental era, providing incentives and conveniences. So the new regulation has brought foreign investments from China to the nickel smelter industry, which is a good thing. So how to implement these policies? First, support from government regulations, of course, and then significant investment for research and development, because it is so crucial for to boost the R&D, because we need to know how to do the most efficient process to generate the best product or yield, and then also strong collaboration from government and industrial sector. It can boost the productivity and the efficiency of this policy. Okay, so the government, domestic business, investors, and local communities can benefit from this program. Also, we learn about currency futures and options market. So the currency future contracts specify a standard volume of a particular currency to be exchanged on a specific settlement date. They are sold on exchange, unlike the forward contracts. For currency call put options, it gives the right to buy or sell a specific currency at a specific price, called the strike or exercise price, within a specific period of time. And that is all for the summary for the lessons that we've learned from week 1 to week 7. And thank you for listening.